India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning and welcome to the CNBC TV 18 Motilal Oswal studio. This is Bazaar and I'm Lata Venkatesh. With me is my colleague Rima Tendulkar. Well, it's one of those mornings when trading is going to be thin, when everyone is actually planning what they are going to do tonight. And there is no US trading tomorrow, or rather most markets will not trade tomorrow. So we could have two things, an extremely thin volume trade and therefore a lot of wonky moves because it's easy to move markets today.
Indeed, there's so much festive cheer outside, but when you look at the trading screen, the way we traded yesterday, it's just a bit like, there's fatigue which has crept in, or it's a little lackluster. And even US markets, they were under pressure for the last two trading sessions.
No, I take your point. That will be the inaugural cue that the US markets had a bad 30th. And whether that will cast shadows, between 1 and 1.2%, all the indexes. But my sense is that what impacts Indian markets, or for that matter, emerging markets, are the other two parameters, which is the bond yields and the dollar index. And there, the bond yields have fallen by 8 basis points, which is usually EM positive. I mean, if you're an algo trader with an EM and a US, trading, and the yields fall, then it is normally positive EM. Likewise, dollar index has slipped below the 108 mark. It's a small fall below the 108 mark. By no means is the dollar weak. But what I'm saying is there is no incremental bad news from both these places. So my sense is this is as good a time as any that the bulls can use, or funds can use, institutions can use to prop up NAVs. Simply because the other props are in our favor. The other point I want to note, however, is that the FIs are not out of the market. Yesterday, not only was there a sell of nearly 2,000 crores, 1,890 crores. Do you see the gross volume? Yeah. It's like 17,000 crore sell and some 15,000 crore buy. So it's a substantial 33,000 crore of participation. That's not a small participation.
But yesterday was also the nifty quarterly rebalance. So stocks like NTPC, for instance, saw a little bit of a weight up. There were a lot of adjustments, so that could have impacted volumes yesterday.
Okay. Thanks for that, Rima. But my sole point is that the cat is not quite away. Nevertheless, I think today is going to be a thin trading day, and I expect a lot of green on the screen and dressed that way simply because I think there will be at least NAV management today.
Okay, but just a quick recap then of how we fared yesterday. Well, yesterday was a bit of a disappointing session because it showed promise. There was an intraday surge, but at elevated levels in the second half of the trading session, selling pressure kicked in. The Nifty ultimately ended at 23,644, a cut of about 0.7% below the 200-day moving average. But just take a look at the key levels over the last couple of days. Now, yesterday, the Nifty made an intraday low of 23,599. This is lower than the lows that we've seen over the last 5 trading sessions. And the high yesterday, 23,915, pretty much coincides with Friday's high. So now the boundary for the market just over the near term is 23,900 on the way up, yesterday's intraday high, and on the way down, 23,600 thereabout. And yes, while the FI selling did pick up yesterday, as Lata said, nearly 1,900 crores sold in the cash market, the DIIs did buy a little bit more. So 21,073 crore was bought by the DIIs in the cash market. The China manufacturing PMI data is also out. So just a quick word on that. It's expanded, which is positive, 50.1 in the prior month, but this is lower than expectations of 50.3. So clearly the stimulus, whatever measures they've announced, is not enough. So the expansion in China is not keeping pace with the expectations. So that's a bit, and we should pull up the Asian markets. Very, very quiet moves so far.
I take your point at that. Let me put just one more worry on the table. The Reserve Bank's financial stability report. Let me first tell you that the financial stability report is intended to check out how banks and financial institutions will do when they are under stress. But it doesn't mean that that is the base case. It is an extreme case.
So it's like a stress test?
Yes, it is a stress test.
Okay.
So, basically, suppose cryptos were to fail. Suppose there is a cyber security risk. Suppose there is a big, bad loan, or there is a big event in global markets. The over leverage that you see in global markets suddenly turns bad. You imagine all these scenarios and then say that loans can, kind of fall. But what the RBI is saying is, even with extreme stress scenarios, Indian banks will not go under. Even if the top 5 banks have this level of stress, even then no bank fails. So actually there is a positive in the report they are giving, and all these are scenarios. They are not exactly what the government or RBI expects, because they have not even lowered their GDP forecast. The GDP forecast is as of December 9th, when they said 6.6. So they're not expecting it. It is a rosy picture as far as the Indian growth is concerned. I mean, 6.6 is bad compared to 7, but it's a good rate of growth to work with. And therefore, we must take these scenarios with a pinch. The only part I would worry about is where they're talking about unsecured loans.
But that's not new to the market, right? We've been flagging it off. Corporates too have been talking about the stress in the unsecured portion, in the unsecured portfolio. So in that sense, it's not that it's a new, fresh negative development for the markets, a new unknown.
No. When Reserve Bank reiterates it, the market worries a bit. Yes, you worried us. Last November, the risk weights on unsecured loans were raised to pre-COVID levels. So, okay, they do say that the percentage of unsecured loan has slowed. But they do point out that private banks are showing high level of write-offs. And there is increasing incidence of one person having multiple loans. I mean, he has a credit card loan and perhaps a personal loan. And he's also a person servicing an auto loan and a car loan. So that worry is very,
documented by